Time now to see what's on the radar for Martin Cobb. He is the Senior Vice President, Equities at Lorne Steinberg Wealth Management. And Martin, right now, as we head into the end of the year, you're liking gold still. It's had quite the run.
Yeah, it's very topical on investors' minds. I mean, who would think when we get to the end of the year and we look back and how strong gold has been and how strong stocks have been, it'll be up there in terms of, and probabilities in terms of just how normally gold does very well as a, as a risk, tail risk asset, as a hedge against, strength of equities. We've had the absolute opposite. So we're getting a lot of questions, not surprisingly, on, where goes the gold price, given that if you look within the TSX, for example, roughly 1/3 of the returns year to date, about 10 percentage points, have come from just the gold stocks.
And is that worrisome, at least on a bigger picture for the TSX? That we're getting 10%?
It's certainly, is it worrisome? To some extent, definitely, because it's a speculative asset, largely. If you look at the gold, there's really two camps, with the gold. There's the Warren Buffett camp, where he talks about it being a big cube that sits inside the infield on a baseball, field, and earns you nothing, And then there's a more like in a James Grant camp, where they view it as an excellent diversifier, an excellent hedge against, debasement of currencies, inflation, and ultimately a store of value. And so there's a real debate. And if you look at this year in terms of being worrisome, what's driven the gold price? You hear a lot about central bank buying. They've been buying really at the margin. If you look at the increase in central bank reserves over the course of this year, it's largely because of the increase in the price of gold, much more than it is to do with the volumes. Although there has been some buying, and obviously getting away from the US dollar, having your reserves in gold, which can be sanctioned, rather than in euros or US dollars, makes a lot of sense. But really, it's been investors buying here in the West, but actually in Asian markets, notably, have been big buyers of gold this year. So it's a speculative asset. And there are speculative drivers to the price. So that is worrisome to some extent. And now in the TSX, 1/8 of your entire investment, if you buy the TSX today, is in gold stocks.
And one of the other drivers you mentioned is also jewelry. I mean, I know we think about gold, but in India especially, it's considered an investment, but investment you wear.
Yes, exactly. So if you look at, we basically see about 5,000 tons of gold change hands every year. So roughly 3,500 tons are mined, and then 1,500 tons are recycled. Now that recycling does react to the price. The more, and obviously, the higher the gold price, the more there is an incentive to recycle. And jewelry is a big chunk of demand, and it's fairly stable. And India and China are being certainly large markets for that to some extent. So they will be a kind of solid driver to ongoing demand. Given that just that jewelry is something you can wear, it looks quite nice, and is a store of value. But really, it's the investment demand that's been driving things, as I say, to some extent. That's the key factor going forward. And will investors continue to put gold away either physically or through ETFs? Now, we had that odd situation in August, if you remember, with fears over tariffs on gold. And so you had, basically airplanes leaving London, coming to New York with gold bars in them, as there was a lot of hoarding, and that's kind of washed through to some extent now. But it's the view of gold as being a store of value, prevention against debasement of currencies. We look at debt levels and spending levels around the world in terms of governments. Big question mark over fiat currencies. Gold obviously has its appeal in that environment.
And would it be a place people would move if they start rotating out of AI stocks and tech?
Well, you would have thought that it wouldn't have been a place they would have moved with the rotation in or the continuation of buying AI stocks. So I think the history books will be interesting to really understand the drivers of gold, which is, Moore, the investment manager based in Calgary, wrote a very good piece, I thought, on gold as being an excellent hedge of tail risk, when things go pear-shaped. It's not typically an asset that does pretty well when, equities are doing well, when risk assets are doing well. And that's been a year, 2025 has been that oddity where we've seen both of that. So I would say it's not badly positioned in terms of just being something you can touch, you can bite, you can store, or you can buy through an ETF. So it does provide that alternative to something like the risk assets of AI stocks, etc. But there's a lot of other things I think would provide that attraction to other types of stocks in the market, not just gold stocks. So I think the setup is reasonably positive. If you look at the gold price today, 4,300, the average year to date is more like 3,300. The gold stocks themselves will enjoy that nice tailwind of higher prices, roughly a third higher, even if the gold price does nothing over the next 12 months.
So you think there is stability to it for the next little while at least?
I think it's interesting. I mean, calling anything on a next little while basis for short term is a mug's game. I've learned that over my 30-year career. But I think the setup on a long-term view, gold is an excellent addition to a predominantly equities type portfolio. Having a proportion, 10% of your portfolio, say, in gold makes a lot of sense. That being said, if you buy the TSX today, you have roughly 12-13% of your portfolio exposed to gold stocks, which are a leverage bet on the gold price. So you have even more exposure to gold than you probably think. So be mindful of that.